right now, Wall Street is treating one of the absolute pioneers of digital payments like a decaying legacy giant that's basically in permanent decline. But behind closed doors, a massive, fast-growing tech darling is actively trying to buy them out. And that right there proves that the public markets are completely mispricing this asset. We are looking at a classic valuation paradox. The tension between what public investors are terrified of and what private equity actually sees is creating an enormous curiosity gap. And the implications for the stock, they are massive.
And that gap is quantified by exactly $53 billion. That is the proposed joint acquisition bid from Stripe and the private equity firm Advent International. They are offering $60.50 per share to take PayPal private. Okay, let's dive into this, because this isn't just some random market rumor. This is the ultimate proof point. The smart money in the private markets is looking at an underlying cash generation machine, while the public market is heavily discounting it just because they're terrified of a transition. The valuation disconnect here is literally staggering. You've got PayPal, which is processing unbelievable volumes globally, trading at a highly compressed forward PE multiple of just 10.5x. Now compare that to Stripe. Stripe is carrying a massive private valuation of $159 billion. Wall Street looks at PayPal and sees a company that lost 80% of its valuation from its 2021 peak, struggling with shrinking margins. But to understand why Stripe wants his company so badly, we have to look past the stock chart and understand the actual economic engine underneath it all.
So what does PayPal really operate? It's a two-sided network effect. It's not just that familiar checkout button you click when you realize your credit card is all the way downstairs. It is a massive, self-reinforcing economic moat. They connect millions of consumers directly with millions of merchants all over the world. Merchants literally have to offer it because consumers demand the security. And consumers use it because, well, it's accepted everywhere. In fact, over 60% of consumers actually trust PayPal to store their payment credentials more than their traditional banks. That structural trust is the absolute foundation of the entire business. Now, the sheer, undeniable scale here is what makes this so fascinating. We are talking about 439 million active consumer accounts and 36 million merchant accounts. They hold a dominant 43 to 45% global market share in online transactions. But the absolute most critical number for investors is at the bottom, over $6 billion in annual free cash flow. This isn't some speculative tech startup burning cash, hoping to find a market someday. This is a highly profitable, deeply entrenched utility. So the crucial question is, if the business is this massive and throws off this much cash, why is the market so freaked out? The central conflict really comes down to a volume mix shift. PayPal essentially has two main lanes. First, you have the branded checkout. That's the familiar yellow button. This is their profit center. It carries a direct take rate, which is basically their cut of the sale, of 3.49% plus 49 cents per transaction. But it's currently only growing at around 2%. Then you have the unbranded processing lane, driven by their enterprise solution, Braintree. This lane is growing fast, in the mid-teens, but it operates as pure infrastructure. PayPal actually has to pay interchange fees to card networks for this, making it a much lower margin business. Wall Street's biggest fear is that this fast-growing, low-margin business is going to completely swallow the high-margin business, creating a permanent structural headwind. But here's the thing. The market is largely ignoring the gravity of enterprise stickiness. High switching costs act as a massive defensive moat here. If a huge merchant wants to rip out Braintree and replace it with a competitor, they can't just flip a switch on a random Tuesday afternoon. They have to integrate complex new payment APIs, pass incredibly stringent security and PCI compliance testing all over again, and completely rebuild their vital data reconciliation pipelines. It introduces material operational risk. The reality is, once an enterprise is plugged into PayPal's infrastructure, they tend to stay there. However, we have to be honest. The bear case is highly intelligent, and we absolutely have to address it. Wall Street is terrified of the ultimate commoditization of payment processing. Apple Pay is the device-level threat that's keeping analysts awake at night. They already command 54% of U.S. in-store mobile wallets. Apple uses native biometric scans like Face ID, which completely bypasses the friction of typing in traditional browser-based passwords. If consumers start abandoning the high-margin branded PayPal buttons simply because double-clicking a side button on an iPhone is easier, well, that margin compression we just talked about is going to accelerate dramatically. When you project this out, you start to see exactly how the tension builds that sparked this M&A bid in the first place. Just look at the 2025 total payment volume growth. Stripe grew its volume by an impressive 34%, reaching $1.9 trillion. PayPal? They grew their volume by 7%. Stripe clearly has a commanding lead in developer-friendly enterprise software integrations. But Stripe needs more volume, and they want Braintree. They want to swallow PayPal's massive transaction flow and seamlessly integrate it right into their own modern architecture. This stark divergence in growth is exactly why the private markets are circling like sharks. But then we get the reality check. On July 28, 2026, PayPal reported its Q2 2026 earnings, and that whole dying company narrative hit a solid brick wall. Net revenues came in at $8.682 billion, officially beating analyst estimates by about 2.5%. Earnings per share hit $1.38, beating consensus by nearly 8%. And adjusted free cash flow was a massive $1.832 billion for the quarter alone. They even raised their full-year guidance targets for 2026, projecting higher transaction marketing dollars and an EPS of roughly $5.38. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
Driving this sudden stabilization is the new CEO, Enrique, who took over in March 2026. He stepped in and immediately implemented a frankly brutal but deeply necessary focus on efficiency. He's targeting $1.5 billion in gross run rate cost savings over the next 2 to 3 years. Through major organizational simplification and aggressive AI adoption, management is actively unlocking margin recovery to offset all those pressures from the unbranded volume growth.
So when we synthesize the fundamental health of the business into a qualitative scorecard, it scores a blended 7.0 out of 10. The absolute strongest pillars here are management alignment and capital allocation, both scoring an 8 out of 10. Laura's compensation is heavily tied to performance share units that only vest if the stock hits significant hurdles between $110 and $125. That's a huge incentive. And their capital allocation is stellar. They are taking that $6 billion in free cash flow and aggressively buying back stock, retiring 33 million shares in Q2 alone. They are systematically shrinking the float to mathematically drive up earnings per share. Loris summarized his entire strategic pivot in one very telling phrase. He said the goal is to become a technology company again. The plan here is to aggressively improve developer productivity and integrate artificial intelligence to modernize the platform. This isn't just about trimming the fat and cutting costs, it's about fundamentally rebuilding the underlying technological infrastructure so they can actually compete toe-to-toe with the agility of companies like Stripe. Now, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems, for under-the-radar names with asymmetric upside; and dividend hunters, for durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes, and Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Okay, before we dive into the valuation modeling, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes over the next 5 years. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
Let's break down the actual operational story that drives this math, starting from a current share price of $59.00. So, what does it take to hit our base case? We assign this a 50% probability. This assumes management stabilizes the branded checkout at low single-digit growth, successfully captures that $1.5 billion in cost savings, and maintains a 16% net margin. If they keep buying back $4 billion in stock annually, EPS hits $9.86 by year 5. Apply a completely reasonable 14x multiple, and the implied price is $138.09. But what if things really go right? In the high case, which we give a 35% probability, maybe they do merge with Stripe, or the AI rollout drives massive operational leverage. Margins expand to 18%, revenue hits over $48 billion, EPS climbs to $12.25, and an 18x multiple yields a staggering $220.43. And the downside, the low case, at a 15% probability, reflects severe execution failure. The Apple Pay threat becomes a full reality, crushing margins down to 13%. Revenue stalls out around $34.8 billion, EPS drops to $6.24, and a distressed 10x multiple drags the exit price down to $62.37.
When you probability weight those specific scenarios, 50% base, 35% high, and 15% low, you arrive at an expected probability weighted share price target of $155.55. Because of the aggressive share repurchases retiring so much of the float and that currently compressed 10.5x PE multiple acting as a hard floor, the upside here dramatically outweighs the downside. It demonstrates a truly massive asymmetric return profile over the next 5 years. If you want to access the full model with all the detailed assumptions for each scenario, you can check out the detailed research report at StockSentinel.ai. But look, investing is fundamentally about managing risk. So here are the concrete, measurable, early warning signs you need to watch. Consider the thesis weakening if overall transaction margins fall below 44%. They are currently hanging out right around 44.9%. Keep a close eye on transaction margin dollars, excluding interest. If that growth drops below 2%, it means the mix shift is hurting them way too much. And if active accounts start showing year-over-year declines, or if free cash flow slows down enough that those trailing 12-month buybacks drop below $4.0 billion, those are major flashing red flags.
And the ultimate structural risk, the real thesis-breaking trigger, is simple: total commoditization. If traditional checkouts are completely bypassed by OS-level merchant platforms, meaning consumers exclusively use device biometrics, like Apple Pay, and literally never have to interact with a PayPal credential again, it permanently destroys their high-margin branded volume. If that happens, the entire margin profile of the business basically collapses into pure low-margin infrastructure. So let's bring this entire narrative together. Here are the 3 absolute most important takeaways. Number 1. You have a dominant global platform generating over $6 billion in free cash flow, aggressively shrinking its share float to mathematically drive up earnings per share. Number 2, you have a new, highly incentivized CEO unlocking margin recovery through a disciplined $1.5 billion cost restructuring plan. And number 3, you have a massive $53 billion private M&A bid from Stripe and Advent, establishing a hard valuation floor and proving that smart money sees extreme value hiding in plain sight. Which leaves us with the final provocative question that pays off exactly what we started with. Is Wall Street entirely mispricing a $6 billion cash flow machine simply because it's navigating a messy transition? The private markets certainly seem to think so. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.